Good morning, good afternoon, everybody, and welcome to our ACRAA webinar on capital market developments in Turkey and the Middle East. This is part of a series that we started last year on informing ourselves about capital market developments in countries in which ACRAA is represented. For this afternoon or this morning, however, we have included Middle East, and some of them are not members of ACRAA, but members of ACRAA, especially the Islamic International Rating Agency, is conducting operations, doing credit rating activities in these countries. So we would like to get to know what is happening in these countries, which are still part of our credit rating universe. In our webinar this afternoon, we shall start, we start with the Middle East, as suggested by our Vice Chairman, Mr. Fahim Ahmad, so that we will have a bigger picture and then zero in on the second part on the country Turkey. So it's going to be, we'll talk about the Middle East first, that will be presented by our first speaker, and then the second speaker will talk about Turkey. So here is the speaker's profile. This is Mr. Hassan Demir. He's Director Ratings for Islamic International Rating Agency. He started really his career as teaching at the University of Virginia in the U.S. and went to banking at Vakif Bank as auditor. Vakif Bank, one of the biggest banks of Turkey. And then he went to equity research as analyst and became economist and strategist. That has been his role lately. He has earned his Master of Arts in Economics also at University of Virginia. So Mr. Hassan Demir is going to be our first speaker. Let me also introduce already our second speaker so that we can go seamlessly from one speaker to another, one topic to another. I would like also to introduce Mr. Hassan Demir, as I said, is Director of Ratings of Islamic International Rating Agency. The second speaker, if you can please project his profile, Mr. Engine. And our second speaker is Chief Economist and Director of Research for JCR Eurasia, which is a member of ACRAA. And he has the Research and Analytics Division. And actually, he's the one who set it up, this new division. And he is, for his very interesting background, really his double major degree in sociology both from METU, and his Master of Science in Finance and Economics at the Universidad Pompeu Fabra of Spain. So a CFA charter holder and a member of the CFA Institute and CFA Society of Istanbul. So he will be our second speaker. Engine, please start.
All right, good afternoon and good morning again. By the way, a quick disclaimer, I am also based in Istanbul, so greetings from there, and things are not looking terrible at the moment, but just in case it gets hectic here, I might lose connection, hopefully not. It's looking good so far, I think. Okay. Shall I share my screen, or do you do it from your side?
No, you may share your screen, no problem at all.
All right then.
There we are. We can see.
Okay, great. So once again, greetings everyone, Mr. Santiago, and our chairman too, to every participant.
Thank you.
So let's start with Turkey. These are interesting times for Turkey, for the world, actually. So what we have here is an overview of like the recent developments in Turkey from a macro scale, and then we focus a little bit more on the capital markets aspects. So please feel free to fill in. Like I think Q&A section is after the presentation, but like if you have like any pressing issues, please feel free to join. So let's start without losing any time. A very quick introduction to JCI Eurasia. As you know, we are a member of ACRAA, so I think most of you are familiar with it. It's one of the oldest rating agencies based in Turkey. And I'm actually one of the old, let's say, employees, like members of JCI Eurasia. I joined the company in 2014, but in 2020, we had experienced a very major shareholder change, actually. So previously, I think of course, you're familiar with our founders, Orhan Bey and Rafi Bey. So they have exited their shares in 2020, and currently our shareholder structure comprises Borsa Istanbul, which is the stock exchange of Turkey. It's our largest shareholder, and then all of the major banks and participation banks, Islamic finance banks, are also members, are shareholders. So now we have a completely institutionalized shareholder structure as of this change. And also we are a member of European Association of Credit Rating Agencies. We always say Turkey is a bridge, so JCI Eurasia is just that. And we currently issue ratings with respect to capital adequacy ratio calculations. So we are the only accredited credit rating agency based in Turkey that can issue such ratings. And I will come to that in more detail. So I will skip this very quickly. The supervision is, like in many countries, dual-fold. Both Capital Markets Board and Banking Regulation and Supervision Agency regulate the system. CMB is more focused on the capital markets aspects, obviously, like debt issuances and whatnot, and particularly structured finance issuances. And BRSA mainly regulates the Basel compliance ratings. So as an external credit rating agency, we are working with BRSA quite often. So this is the supervision aspect of it. Okay, and this is the last slide talking about JCI Eurasia. So just a few highlights. Previously, in Turkey, as you know, we are the oldest. So we averaged like 100 to 110 rating observations annually. But after the transition with the shareholder change ends, once this came into picture, currently all of the non-financial corporations with a loan balance exceeding 500 million euros, which is like roughly $45 million, has to have an external credit rating in Turkey. And since we are the only institution with such such a license, we issue a lot of these ratings. And here you can see this average 110 has reached almost 1,000. And our projection for 2022 is actually 1,200, so 1,200 for 2022. And just to give a flavor about the distribution, like we have more or less, like not normal, I mean, I can't call it normal, obviously, but this shape, this is looking like an outlier, but in the gray shades, you can see the state-owned or state-backed projects. As you know, in Turkey, we have a lot of these PPPs, like public and private partnership projects. Most of them have state ratings, so they have high ratings. And with that, I would like to talk a little bit about Turkey, the macro picture, and then I will focus on the capital markets aspects. So you may or may not be familiar with the numbers, so I brought them up just to refresh our memories. So as of last year, this is the GDP size. We have grown like 11% annually in total year based on the previous one. So the population is quite large, but in this, the workforce is not as large as the population itself. Labor force participation rate is not very high actually compared to OECD countries. So we're talking about a 33 million workforce. And these are some trade statistics. So in total, we have like more than $500 billion of total trade. Compared to the GDP, you can see just how open the whole economy is. And of course, due to the basis effects, these numbers are quite large. Because of the COVID and all the restrictions, the trade has slumped, obviously. So this is like the snapshots. Now let's dive into the GDP growth a little bit. Currently, one of the big topics in Turkey is changing the growth model, actually. So this is why I have this like detailed GDP contribution graph. So here you can see the key aspects of the GDP growth. So the current strategy of the administration is to promote exports, like net exports, actually. So they do this via like currency depreciation and selective credits packages to net exporter companies. So rather than just providing loans without any attention to the sectors, now they're focusing more on net exporters. So here you can see in this like light blue color the contribution of the net exports. They have been quite important actually. And this is a net change in inventories, and this is indicative of the need for additional investments, capital investments. So the idea is to finance those capital investments and focus on like net exports. But of course, this is 2022. We have an ongoing like Russia and Ukraine crisis. We have this energy crisis, skyrocketing prices. So there have been some major setbacks in this agenda, some external factors. On the right-hand side, you can see the inflation test. These numbers are quite unique in the world, I know. So this PPI is triple digits, and CPI is exceeding 50% per year. So massive numbers. This is twofold. One of them is obviously the direct import channel. Turkey is a net commodity importer country, so we don't have like energy and basic metals, so we have to import them. And since the price of these commodities has increased like 40%, 50%, for some of them doubled, we have experienced a massive price shock. And this is multiplied by the sharp FX depreciation. Like Turkish lira is a floating currency. So last year we were talking about 7 and 8 liras per dollar. Now we're talking about 14 liras per dollar. So like almost doubled. So these two factors multiplied and resulted in a very significant inflation figure for our country. And the baseline assumption is that this will continue like 40-45% across the year and fall to 20%, 25% by the end of year, hopefully. But of course, all of the ongoing tensions are problematic in that regard. So this is the budget performance. And on the right-hand side, so this is indicative of when you factor in the GDP, this is less than 3%, it's 2.3% if I'm not mistaken. And on the right-hand side, you can see the current accounts. The current account deficit has been an ongoing issue in Turkey. But like I said, with the next net export prioritization strategy, we now see the positive bars, and we observed those positive bars. But then came the like oil shocks and all the increases in commodities. And currently we have the January figures, and they don't look very pretty actually. So $10 billion of trade deficits has been posted for January. So we might again see a downturn, but hopefully it will recover periods. And we don't expect the energy prices, oil prices, to maintain their very high levels across the year. This is the financing of the capital accounts. So this is a bit detailed, so I will not focus too much on this. But on the right-hand side, you can see the net FDI inflows, and you see the contribution of real estate. This is on average like $5-6 billion per year. And especially from Middle East and some of the Asian investors, we see like big interest into like real estate markets in Turkey. So, and one of the reasons is this subsidy program. So any real estate exceeding a certain threshold gives the right to the purchaser to obtain a citizenship in Turkey. So this is quite a popular program. And here you can see like most of them are for like services sectors. And then we can focus on the capital markets now. So a brief overview concerning this. We mentioned like the population is 84 million and the workforce is 33 million. So the adult population is more than 55 million, but capital market participants are not very sizable actually. So there's still very much room for growth. One interesting aspect here is, as you know, with the pandemic, as people started remote working and they had some free time on their hands, with the volatilities in the market, we have seen the surge of retail investors. This has definitely been the case in Turkey as well. Here you can see like we added like almost, not doubled, but very notable increase with the pandemic. Like people have flocked to the capital markets and particularly into equity markets. So COVID has jump-started this, but then again, their assets are actually quite low. And here you can see the distribution of total capital assets. So the lion's share is actually like government bonds. In that, like corporate bonds are quite slow. This is actually $1 trillion, 2.3 trillion liras. This makes like $150 billion. This is the market capitalization of Borsa Istanbul. So compared to the peers, the multiples are quite low actually currently for Borsa Istanbul. And these are just numbers about the firms operating in Turkey in capital markets. Most of them are actually like brokerage institutions, but the pension management companies are quite notable as well. They have increasing assets under management with inflows, with voluntary inflows and whatnot. So this project, you might be familiar with it. Perhaps you have heard of it. But this is one of the landmark projects, again, of this administration, like Istanbul Finance Center. So the idea is to consolidate all of the major regulation and supervision agencies and financial institutions at a hub, and also attract like foreign investors and foreign financial institutions to this hub as well. And they do this via providing certain incentives, like tax incentives, like social security premium incentives and whatnot. So the idea is to have like a financial center, financial hub in Turkey that could service both Turkey and also like the region, and particularly like the Middle East, perhaps like North Africa and like Near Asia and whatnot, especially with respect to like sukuk and other other Islamic finance sectors. So currently the project is ongoing. They hope to finish this by the end of this year, and once it's online, the reach of it is expected to like increase. Okay, so with that, let's dive a little bit on the corporate bond markets, since we are all like rating agencies, like rating experts. Our focus is usually on the credit markets. So let's talk about credit markets a little bit. In Turkey, the financial sphere is mostly dominated by banks. So the bank financing is almost like 95% of total financing in Turkey. So only 5% remains for debt capital markets. So, and even there, even in the corporate bond market, we see the dominance of, again, banks and non-bank financial institutions. How so? They tap the corporate bond market more often than non-financial companies. So these are the outstanding balances, not total issuance, but outstanding as of the year end. It's like this is in liras, so in dollar terms, it's like $10 billion. So we can say like $10 billion of corporate bonds were outstanding as of last year. So this is actually compared to a GDP of like $800 billion. Sectors, this is quite small actually. And who owns all these corporate bonds? Well, these other financial corporations actually comprise pension funds and other management funds. And then we can see some households. They mostly hold bank instruments like debt issuances by banks, and then we see some other banks holding each other's assets and whatnot. So this is who holds it. Okay. Here we can see the total issuances. So this was the volume outstanding, and this is the total issuance. So 258 billion liras. Again, this is what is it? Like $15 billion worth of total bonds were issued last year, and we expect this to rise perhaps to 280, perhaps to 300 billion liras by the end of this year. And again, in this, non-financial corporations only account for like 3% in 2020. So most of them are again like banks and other institutions. So this shows just how reliant the non-financial sector is on bank financing. So there are some projects to incentivize, like to kickstart this corporate bond market, and I want to talk a little bit about this. And this is this bond guarantee fund mechanism. So this is not in execution currently. This is a project, and hopefully it will be finished soon. So this project entails building a fund, building a pool, actually, from the market participants, from the issuers and also potential investors, and collecting premiums into this fund. So in case of like I said, default, then this fund would, based on certain conditions, this fund would take action and reimburse the market participants, the investors. So the aim is to like incentivize the households and also certain institutions to take more part in the corporate bond markets. And of course, there are some potential considerations, like on the legal aspects, to avoid like any sort of moral hazards and whatnot. So these are important issues. Currently, like the debate is going on, some discussions are going on with this. So it's not yet final, but we think this would be like a big factor in promoting corporate bond market in Turkey once it takes place. Okay, and with that, we have been talking about the banking sector, like bank dominance. So let's focus a little bit on this. Yeah, okay. Before that, the sukuk market. So it's been growing actually very rapidly. There is the most of these issuances are from the participation banks, but the government is also issuing certain lease certificates. The treasury is issuing certain instruments, and they plan to do more in the near future. And actually, there is a dedicated office in the administration for like sukuk market and for this finance, actually this Islamic finance sector. So there's quite a bit of emphasis on this aspect as well. And this would probably rise. And this is working in parallel with the like finance sector. So these two projects are actually working hand in hand. Okay, now let's talk a little bit about the funding market. So these figures in like billion lira, so this is maybe like lira, may not be very relevant, but this is dollar figures. An ongoing issue in Turkey is that we had this huge dollarization. At its peak, 65% of total deposits were FX deposits in the banking system. So quite large. But now we have a new product called FX protected deposits, which essentially gives the depositors a free call option. So they are guaranteed a minimum interest income. And if the currency depreciation is higher than the interest income, then they are entitled to the difference. So let's say the deposit rate is 15%. They will have this 15% typical term deposit. And if during that period, currency depreciation is like 20%, then they have an additional 5% depreciation difference reimbursement. And this is denominated in liras, not dollars or euros. So, and this is offered to both households and corporate institutions. And in fact, there have been certain incentives for corporates to tap into these deposit mechanisms. So with that, we have seen a reversal of the trend. So from the peak of 65%, it has been coming down. But we will see how it goes as the time goes by. But so far, it has put a brake on the dollarization. And on the NPL side, I mean, with all the restructurings and like support, it's only 3%. And the capital adequacy ratio is sizable. And recently, the state-owned banks, which are actually the largest in the banking system, among the largest, they have been recapitalized again by the sovereign wealth fund. So they will be able to like lend more. And this is the breakdown of the loans. Like most of them, as you can see, the corporate loans and retail loans are not as big. And currently, there are some macroprudential measures to limit actually the credit growth in the household, like retail sector, because of the inflation pressures, and focus more on selective credit policies to the corporate sector. So this is the general picture of the banking scene. And a few last words about the sustainability and ESG considerations. As you know, this is one of the hot topics. So like major highlights in Borsa Istanbul, like the stock exchange, we have a sustainability index. So firms fulfilling certain criteria set by the Borsa Istanbul are listed in this special index. So this is one of the big developments. And Turkish companies have been raising quite a bit like sustainable or green debt abroad. And also the Treasury is also planning certain issuances in that regard. So this is one of the ongoing aspects. And as JCI Eurasia rating, we have been like committed to United Nations principles of responsible investments. And of course, we have our like prominent shareholder, Japan Credit Rating Agency. And they have very kindly they've been guiding us on this bond market. And as you know very well, the JCR is very like strong in Japan green bond market. So they have been kindly sharing their expertise with us in that regard. So we think this ESG financing will be one of the big topics in Turkey for both of the funds raised in Turkey and also for abroad. So yeah, and the main takeaways, like Turkey is, let me just recap with this. Major economy, but we have been facing certain headwinds in especially inflation. Current account deficits has been a problem. We're trying to fix this. And then major capital inflows into real estate. The valuations are quite low, so we expect more inflows once things stabilize a little bit more. We have this finance center and sukuk market ongoing, and we think this sustainable and ESG financing will be important issues in the near future. So this is the recap of the Turkey capital markets on our side. Thank you very much.
Thank you very much. Thank you very much. I would like to, Farial, will you help me with with our question and answer session? I would like to entertain any questions or comment from everybody now. You just raise your hand. People are still warming up, I think, but let me. Masuda-san, yes, our chairman.
Merhaba, Ozuguru-san. It's quite time. Thank you very much for joining this time to this important seminar. We welcome your participations and we thank you very much. I have two questions regarding to Istanbul market. And can you explain non-resident issue in Istanbul market? And to what extent and the non-residents is thinking about, I think Istanbul is a quite international market, and the government is now contemplating this and the Istanbul Financial Center. Do you think, do you have any result, achievement, and what will be potential of this non-resident? That's the question number one. And the question number two is just recently, your government is did a remarkable success for sovereign sukuk. Can you explain that how this sovereign sukuk was well received by Turkish investors? And the first point is also related to the investors. To what extent a Turkish investor is willing to making non-resident investments? That's those are questions. Thank you.
Thank you so much, Masuda-san. It's very nice to have you here as well. So, okay, as for your first question, if I'm not mistaken, this Istanbul Finance Center project, you asked about the foreign interest in the finance center, is that? I don't know if they've released all of the applicants or existing tenants yet. So far, what I know is these public institutions, Central Bank and BRSA and Exim Bank and whatnot, they are they're both actually shareholders in the project. So they have their own buildings. They've been moving on. And I think there are some talks about certain asset management companies from both Middle East and from London, but actually I really don't know the names and the terms of how they are going to do this. But what I know is once the project was launched, there were certain sizable incentives for both the corporate tax, if I'm not mistaken, and also for the employees. So any expats working, I think they had to be expats, so not Turkish residents, but let's say a London firm comes in and they bring their staff. If I'm not mistaken, social security premiums paid for their salaries were reduced very notably. So there were all sorts of incentives to have people join there. But you might be familiar, the project was actually delayed a little bit. So it was supposed to be completed earlier, actually. So there have been some changes with the main contractors. So now a different consortium of builders are actually doing the project. And actually Turkish Wealth Fund is now like the main sponsor of the project. So now they're sitting on top of things and they're monitoring it very closely actually. So I think this might be related with the pickup in the occupancy and whatnot. So once things like takes more material form, it might perhaps accelerate a little bit more. And I think your other question was related with this recent like sukuk issuance of the treasury. Are you specifically referring to this 5-year tenor issuance with $3 billion like placed abroad, right?
Very big one.
Yeah, okay. Yes. So I think the yield on this was actually, we are witnessing interesting times, but still the yields for especially 5-year tenor in benchmarks are quite low. So this was priced as 7.25%. I think this would be very, this was probably a boon for the investors. I mean, not necessarily for Turkey. This isn't very cheap financing, but so this was in that sense very well received, I think. So the oversubscription was 5 or 7 times, perhaps even more for this yield. And this is for, of course, the overseas market. But you are right to point out that the Treasury is also issuing these certificates in Turkey as well for the domestic market. And actually, most of them are placed with the banks. So the banks, and not the retail investors, but actually the banks are quite active in there. So from the auctions, we do not see like who buys how much, but Treasury shows us the distribution, like the top 5 distribution without giving the names. So we usually see like top 2 purchasers account for like 60 to 70% of the total issuance. So the names are not public, but we might have a guess. And I think I missed your other question, and there was another question.
Yeah, my question is to what extent the Turkish investor is buying to foreign bonds and also those sukuk? Is there any change of investor side attitude?
Yes, yes. Okay, so Turkish investors investing abroad, like for this, right? Okay, so actually, Turkish investors, like even in the local markets, are not like very big on capital markets. Household assets, I had some data on this. So typical Turkish investor actually keeps most of their savings in plain deposits, FX, and gold. And gold is very like traditionally like big investments in Turkey. So even in Turkey, they are not very big in these capital markets. But some investors with a certain wealth threshold, let's say more well-off people, they are actually very big purchasers of Turkish Euro bonds. And I think the reason for this is I mentioned the dollarization, and you are, of course, very well familiar with the dollarization issue in Turkey. FX interest rates, they're rising a bit, but they are very low, actually, like 1%, 2%, and whatnot. But Turkish Euro bonds return, like their YTM is around like 7% for certain tenors. For long tenors, even more than that. So certain, what I know is certain like high net worth individuals and even like middle class investors are actually actively purchasing those Euro bonds, like Turkish Euro bonds abroad. I mean, not in the like primary issues, but in the secondary market. They're very big, actually, investors of these Euro bonds. And also for like for the sukuk side as well, because certain people who hold gold and FX do this to avoid interest rates because of their like sensitivities. So these people are very much interested in purchasing those sukuk or lease certificates issuances.
Okay, thank you very much for explanation. Teşekkür ederim. Çok teşekkür ederim.
Thank you so much.
We have one more question that has been asked by Muhammad Wasif. If I can just read that out to everybody. How do you see Turkey's economy performing in the coming decade while incorporating the factors of global tension?
Okay. Yeah, okay. Well, that's a short-looking question, but actually it's a very long question. Okay,
That is true.
Let me just sip some water before I attempt to answer.
Okay, sure, no
Okay.
problem. So why
Sorry.
don't we start the next presentation, Mr. Santi, and then we can
Okay.
come back to this once we've done Middle East as well.
That's right. We'll have more time for more questions after the second speaker. Is Hassan ready now?
So I will talk about the Middle East and North Africa. And as seen from the slide, it covers a very, big region in terms of the population and the geographies it extends. But I will focus mostly on the GCC as well as the Egypt, which is the largest country in the region with over 100 million population. Before that, I will briefly talk about ACRAA. ACRAA was launched as an infrastructure institution by the Islamic Development Bank to help Islamic finance and the development of the local capital markets within the OIC countries, Organization of Islamic Cooperation countries. So ACRAA currently has ratings on corporates, Islamic financial institutions, sovereigns, as well as Sukuk ratings, and it's recently launched Sharia compliance ratings within the scope of IOF's GSFI 10. And the countries we cover extend to GCC, Africa, having Egypt, Algeria, Tunisia, Nigeria, and Sudan, and Turkey, Syria, Iraq, and Jordan, as well as extending to Malaysia, Pakistan, and Kazakhstan in the East and Southeast Asia. And the primary objectives of ACRAA comprise, but not limited to, developing an alternative rating approach to Islamic institutions. And with its unique fiduciary rating framework, ACRAA introduces the Sharia risk element to the ratings for enhanced investability. And as I said before, also to extend the coverage of ratings to new markets and as well as go deeper within the OIC countries. And of course, to help develop the growth of the Sukuk markets. And ACRAA is recognized by several central banks, as well as being on the approved rating panel of the IDB. And these central banks include Bahrain, Jordan, Sudan, as well as the Banking Regulatory Authority of the Turkey, Astana Financial Services Authority, Pakistan Security Exchange Commission, and the National Insurance Regulatory Authority of Sudan are the other regulatory agencies having recognized ACRAA. And recently we got the recognition by the Central Bank of Iraq and started rating the Islamic banks there. Okay, so having talked about ACRAA, I can touch upon the first basic macroeconomic developments in the MENA region. As seen in the table on the left, upper left, the MENA region and the GCC recovered at a relatively lower pace in the year 2021. Which was mostly, because of the OPEC output cuts, we could say, and the travel restrictions, despite the fact that the oil prices were fairly high in the year 2021 over 2020, OPEC cuts has mitigated the prospective recovery. But when we look at the table, going forward, of course, disregarding the prospective impact of the Ukraine and Russia conflict, The world growth, as per the World Bank, is seen to decelerate in the year 2022, but as opposed to the expected acceleration in the MENA region for the year 2022. And given the current conditions and given the relatively isolated stance of the GCC, given the current conflict and the huge jump in the oil prices, this gap could be even bigger in the year 2022 for the benefit of MENA and the GCC region, actually. And just yesterday or day before, Energy Administration of the USA has revised its oil price assumptions for the year 2022 and 2023. And accordingly, Brent prices are expected to average $105 US in the year 2022, which denotes around 48% increase over the year 2021, which will be, of course, very beneficial for the oil export in the region. And since I will cover mainly the GCC, it is a very big positive for the region. I would like to draw your attention to another point. I think personally, it will be very beneficial, I mean, for the MENA and the GCC going forward, because in the last 5 years or 10 years, there were several conflicts stemming in the region, and which is the most troubled, I mean, regions politically, as you appreciate in the world, actually, the MENA. But starting from the Abraham Accords with UAE, Bahrain, and Morocco, you know, recognizing Israel, and they are getting closer to Israel, as well as the, you know, Qatar's agreement with the big GCC players like Saudi and UAE, and as well as the, you know, Saudi Arabia and Iran started the dialogues, constructive dialogues, which could be very positive for the intra-regional trade going forward. And lastly, actually, in the last month or so, we have seen UAE and Turkey getting together after years of hostility, let's say, and they had some deals on the financial front, swap agreements by the central bank, and some FDI promises, etc. So overall, these geopolitical developments, I believe, will be very beneficial for the region. And of course, the MENA will recover very fastly, but each country have a separate driver of growth aside from the oil prices. For example, Saudi Arabia will be growing from pent-up consumer demand, as well as the oil, of course, and the government infrastructure investments. Whereas the UAE, we have a little bit different thing going on, with the Expo 2020 taking place in late 2021 and extending into 2022, brought some momentum for the tourism, and as well as the real estate sector, which is, I think, very crucial, that the prices have been going down all the way in the last several years, but they started to rebound, and the real estate sales are going very well in the UAE, which will be positive for the economic activity. And Qatar, as well as the new investment for the expansion of LNG investments, the Qatar will host the World Cup this year, and it will also help its you know, growth prospects. Even though I said my discussion will be limited to like Egypt and GCC, we can talk a little bit about Tunisia and Morocco. Morocco will be relatively weak in the year ahead because of the base effects of the agricultural production, which was exceptionally good in 2021 and will be much weaker in 2022. And considering that the agriculture is around 10% weight in the GDP, it will be a drag on the growth. Tunisia has been like stalling all the way down since the revolution. All political volatility has been continuing. And this year they will have the elections and the IMF deal, and things could improve a little bit. But one of the big ifs is the recovery of the tourism for Tunisia, which following the Ukraine and Russia conflict could perform worse than expectations and hold the expected growth. And having discussed all these, and I will talk a little bit about how the Russia and Ukraine conflict could impact the region and the economy overall. I mean, of course, Russia being the exporter of the most crucial energy commodities has elevated the prices of the oil and gas, as well as the other commodities, metals, palladium, nickel, aluminum, etc. So there is a huge inflationary pressure coming from these conflicts. Russia is also a huge producer of wheat, which is also bringing up the overall prices globally. So there is the inflationary pressure coming from there. Also, what we see that the energy costs and the gasoline prices rising, especially in the United States, where the consumer confidence depends heavily on the prices at the pump, is to lower the overall consumer demand and hamper the world's growth prospects. Of course, the travel is another big travel, and the tourism will be another channel to impact the global growth prospects. And in that MENA region, particularly Egypt, Tunisia, to lesser extent UAE, because UAE has other energy sources. So Egypt will be particularly hit in this region because of this volatility. And if Russian tourists could come or not will be a big factor in their economic prospects going forward. So to the next slide. So inflation, as I said, inflation was on the lower end in the recent years, but I mean 2022 there will be a big upward hit possibly to the inflation. But I mean the GCC countries will take advantage from the peg to the US policy rates, and given their huge oil buffers and the windfall gains, they could contain the inflation. But Egypt, Tunisia, and the other importers of energy will have problems in the face of these commodity price shocks. And as we've seen in this table here also, of course, the oil prices determine the region's overall fiscal accounts and the current accounts. And the GCC will have huge surpluses in the year 2022 and solid fiscal accounts, which will reflect into its debt securities issuance, as we shall see in the later slides. One of the, before going into the next slide, maybe, also in the GCC region, one of the things we see particularly from Saudi, Qatar, and UAE, the larger economies, is the diversification attempts by the respective governments. To that end, they have introduced several taxes in the recent years, VAT, etc. And this year we have seen Emirates introducing the corporate tax at about 9%. So this will also help the diversification of their fiscal receipts away from the oil revenue. So just very briefly, we will touch upon the capital markets. So like Turkey, most of the GCC, MENA region countries also depend heavily on the bank funding, not to the other options, as seen in the table here, which denotes their dependence on the bank funding is well above the high income average of the world. However, what has been crucial is that these countries, and particularly I have to say Saudi and the UAE, which are the leaders in terms of converging to the best practices in the region, and the leaders in terms of the corporate governance practices as well, they are attempting to increase the penetration of the capital markets. Like Dubai announced the prospective listing of several government-related enterprises in the Dubai financial market going forward. And we have seen some state-owned entities going into public by the Saudi Arabia. Also, another aspect is, again, these two countries are leading the pack, is their convergence to the global practices. For example, as you might have heard, the UAE has, made their weekdays similar to the world. So they have 4.5 weekdays from Monday to Friday, work days. And UAE increased the foreign ownership limits in most of the industries, and as well as announcing fee reductions for government services in several states. So penetration is low, but the countries are doing what they could to increase the penetration. So this is the table of the Arab Monetary Fund. So it excludes Iran here. Iran is also another big market. But excluding the Iran, when we look at this table, in the region, with the total equity market cap being around $3.8 trillion, most of it stems from the Kingdom of Saudi Arabia. Around 70% comes from the Saudi, and around 12% from Abu Dhabi, and followed by the Qatar at 5%. So when I talk about MENA, I talk about GCC, and after this, most the things relate to Saudi Arabia in terms of the magnitude. Of course, Saudi Arabia dominating the market cap, it also dominates trading value, and the overall trading, around 3/4 of the trading stems from Saudi Arabia. And what we have seen during the year 2021 is the trading activity increased by around 20% in the GCC region, as seen in the figure below. The GCC region trading activity reached around $790 billion. And if we go back to the table here, the foreign ownership, of course, there are some effective foreign ownership limits. And the foreign trading among the overall trading is on the lower end, particularly with the Saudi Arabia at 7%, and the upper end in Abu Dhabi and Dubai, 49 and 43%. So next slide, we talk about the performance of the MENA region equities. If we take the best proxy for the MENA equities performance as the S&P Pan-Arab Composite Large Mid-Cap Index, so we see that it had a huge return in the year 2021, approaching 36%, and it was well above the MSCI EM index, which returned around -5%. But of course, one of the driver of this relative outperformance, again, as we see in the figure, it was the MENA region's huge underperformance in the year 2020. Of course, 2020 was extremely terrible year for the region, given the plunge in the oil prices, which, so 2021 can be seen as a recovery or catch-up year, but it was a relatively huge gain compared to the, overall market, and it was, it outperformed the emerging markets, but as well as the developed markets, as the MSCI Developed Market Index returned around 20%. So again, this is similar slides. So GCC markets posted around 35% gain during the year, and it was led by the Abu Dhabi at 68%, followed by the Saudi at around 30%, and Dubai followed with around 28% gain. If we look in terms of the sectors, which economic sectors were the outperformance, we see that the financial services, followed by the capital goods, materials, and the materials were the outperforming sectors, whereas food and beverage and drug retailing were the underperforming with posting negative returns. So overall, what we can say is the like high beta sectors or aggressive sectors, like if financial sector outperformed, while defensive sectors were relative underperformance. And here we have the multiples, but before going to the multiples, I want to take your attention to, I talk about S&P index, but MSCI GCC is also a good proxy for the only GCC region when we only look at the GCC. And if I look at the components of the MSCI GCC index, it is mostly financials at around 60%, and 15% is materials, 11% is communication, and 5% is energy. And since Saudi dominates, its weight is around 62%, and UAE is around 16%. And I just checked, so the trailing PE numbers here isn't the most recent. I just checked the most recent I could find. It was the end February numbers. So as of end February, MSCI GCC trades at around 21 times price to earnings ratio in terms of trailing PE. And it is relatively, at a similar multiple to MSCI World, which is 20 times. But MSCI emerging markets traded around 13.4. So GCC is trading at very rich multiples compared to the EM markets, as well as trading at very rich multiples versus countries like Malaysia, Pakistan, and Chinese market as well. Only India is trading at around 25 to 26, trading at a premium to GCC. Okay, so what you see here is that GCC is at a premium to emerging market peers. But of course, in the recent years, one of the factors for GCC's relative stance was the inclusion of the GCC markets in the respective, global benchmark indices like FTSE, Russell, and MSCI. So Saudi Arabia was included in MSCI EM index in late 2019. And again, Saudi Arabia Tadawul included in FTSE Russell in 2020. And Abu Dhabi index was included in FTSE Russell in year 2022, this year. So next, we will talk about, after briefly discussing the equity markets snapshot and the performance in the year 2021, we will talk about the IPOs. So in terms of the IPOs, globally 2021 was a very good year, also due to the base effect of 2022. But for the MENA region also, the equity ECM, let's say ECM operations amounted to 14.5 billion, well above the previous year, and more than 55% of the deals were IPOs, and the rest was the secondary market offerings. And if, as you see in the middle graph, there was a huge increase in the proceeds across the board. And the largest offering was not in the IPO market, but in the secondary market, the Saudi Telecom's follow-on issuance of 3.2 billion, when the National Wealth Fund or the Public Investment Fund of Saudi sold 6% of its stake. As in terms of overall trading and overall market volume, in the equity capital market operations, Saudi Arabia was also leading the pack, commanding around the 60% of overall deals. And energy and power was the most active economic sector in the IPOs. of the MENA region. MENA region equity capital market operations. In terms of IPO, as you see in the left upper hand graph, in late 2019 we see 26 billion offering by Aramco. Was a huge deal in the markets. And in the year 2021, there were 20 IPOs in the GCC region, as opposed to only 7 in the previous year. And the IPO proceeds increased around 4.5 times to 7.5 billion USD. And the main issuances on the IPO front in GCC was the ACRAA's 1.2 billion IPO, as well as the Abu Dhabi National Oil Company's convertible bond sale and 1.1 billion sale of its subsidiary as well, IPO. But more interestingly, we have seen the Tadawul Group, which is the stock exchange and owning the stock exchange of the Kingdom of Saudi Arabia, and it's a group having capital market operations. It raised over 1 billion in the share sale in the later part of the year 2021. And coming into the M&A activity, again, like the trades, IPOs, secondary offerings, M&A was also relatively strong, and Saudi Arabia was the most targeted nation as well. But overall, if you look at the M&A activity in the MENA region, it was up around 40% during the year 2021. And Egypt, also in Egypt, as seen in the figure 2, deal activity in the Egypt also was strong and covered various sectors, with a large scope. But overall, if we look at the deal size, again, as expected, energy and the power was the largest sector, having around 35-40% share in total deals. And the largest M&A deal was the Aramco's 15.5 billion lease and leaseback agreement for its pipeline. So, as I was discussing in the 4th or 5th slide in the capital markets snapshot, these led by, again, Saudi and UAE, there are attempts to increase the penetration of the capital markets across the board. Again, in the Abu Dhabi exchange, there was an introduction of the derivatives market in the Abu Dhabi exchange. In Dubai, there are plans to list 10 government-related enterprises, including the Electricity Water Authority, to increase the trading volumes. And also in Dubai, we see the approved 2 billion market making fund and 1 billion dirham fund to support technology companies' IPOs. And in Qatar, there was a secondary market catering to SMEs and growing companies. Also, it is not written here, but in the Saudi market, they were giving incentives to increase listing in the secondary market, which is called NOMO, and as well as IPOs in the large, main market, Tadawul. There are several mid-cap issuances in the NOMO as well. Okay, so to conclude for the equities, so we discussed the 2021 performance and the stock market constituents and the IPOs and M&As. So what could be on the horizon for the MENA and GCC equities going forward? So what will drive the performance is the outlook of the economy and the geopolitics, maybe more importantly, I should say. Of course, 2021 was a very good year with a huge outperformance, and the region, as I said, MSCI GCC multiples are very rich compared to other EM peers. And looking at from that perspective, we should see some moderation in gains, and considering the overall pressure on the markets and the volatility stemming from the Russian-Ukrainian conflict, there could be downward, things to observe. But I would emphasize here mostly the upside potentials going forward. And one of the things is the, of course, high oil prices, which will spur government investment and the local demand, and there will be huge liquidity in the system. And second thing is, as I said, MSCI GCC, around 60% of it is driven from the banking sector. Like Al-Raishi of the Saudi Arabia is around 18% of the whole GCC index. So the banking sector performance will be very crucial for the 2022 equities outlook for the region. But in the year 2022, we know almost for sure that there will be some rate hikes in the, by the major central banks like Fed. And we know that, as I said before, the GCC countries, the most crucial are, have pegged their currencies to the dollar or the currency, hard currency basket. So rate hikes by the Fed will imply hikes by the, local central banks. And the bank's balance sheet and the P&Ls are very sensitive to the rate hikes. And like 1% increase in the interest rate would translate into 10 to 15% increase in the net income of the banking sector. So unless, Fed, due to some geopolitical issues or some other issues, stop hiking rates after hiking in March, next week, we will see definitely upside risk to the banking sector. So which will help elevate the GCC multiples, I would think. And geopolitical improvements are also positive for the region. Of course, this Russian deal, I have mentioned all negatives in the macroeconomic section, but one of the positive could be regarding Iran. If the Russian gas or oil is banned across the board, Iranian nuclear deal is, could accelerate and help, Iran. And Iran also get together faster with the GCC, countries. And Qatari World Cup and infrastructure spendings also, as I said, would be positive. One thing is to talk about, aside from the GCC, is the Egypt maybe. Egypt, trades at relatively poor multiples versus GCC and the EM averages, actually around 7.5 times PE versus 13.4 times for the EM at large. But Egypt, up until now in the last several years, currency was relatively stable, performed better than the most EM peers, thanks to the huge carry yields that the government has given and the IMF, deals, etc. But this year things could go a little bit awkward if we see significant decline in the tourism sector. And the tourism is an important portion of the Egyptian economy. So, headwinds could be there. Despite the cheap multiples, Egypt could see some downside risks. And actually, again, the long-term transformation agendas of the countries like UAE and Saudi would definitely support the infrastructure and the economic activity. And actually, if I checked, as of end of February, GCC market seems to outperform the EM market at large by a significant, margin, like 12% gain for the GCC, as opposed to negative, minus negative 5% return for the EM at large. So 2022, so far so good, we could say, for the GCC, but of course the downside risks are there. And regulatory developments is the latest, catalyst, we should say. So having talked to maybe too much on the equities front, I want to go on to the debt market And as seen on the here, this picture or figure, debt market issuances was globally a little bit lower, but in the MENA region, it was a little bit higher, actually, like 2% higher versus 2% decline globally. And if we look at these bond issuances number figure in the middle, we see a huge increase in Egypt, UAE, more or less same, and Saudi, there was a sharp decline, as Saudi has introduced some thresholds for its, government debt limits, and also, of course, 2021 was a relatively good year in terms of, fiscal balance sheets of the governments, actually. And Egypt issued, as I said, over 61 billion bonds during the year, and it was mostly, I mean, not if not all, government issuances. And it also reflects into the overall MENA region with government issuance comprising over 2/3, followed by the financial sector and energy. Okay. And when we look at this one, here it's a very crowded maybe picture. But what we want to see here is that in this middle graph, if you look at the Eurobond hard currency issuances in the GCC sector, it was only 136 billion in 2010, then increased by 50% in the next 5 years to over 210 billion in 2015. But in the next 6 years, until 2021, there was a huge increase, 106% like increase. So that in the last 10 years, overall hard currency bond market quadrupled in the GCC. So this is outstanding amounts, not flow, but the stock value, but we see there is a huge increase. And consequently, GCC bonds make up around 12% of overall Euro bonds in the emerging market space. So there is a huge increase, as we see. And looking at the issuance, in the 2021 only, it was around 147 billion compared to 151 billion in the previous year. And what is more, let's see, noticeable is that Sukuk issuances were increasing, whereas the conventional debt issuances were decreasing. So the share of the Sukuk in the flow, yearly flow, debt issuance increased to actually around 39% of total issuance, whereas it was like 34 in the year before. And as we said in the previous slide, 538 is the overall stock in the GCC, and UAE leads the peg here at 192 and followed by the Saudi Arabia. As in the equity markets, they are followed by Qatar, and Kuwait, Bahrain, and Oman is relatively smaller players. But there is some, thing to observe maybe between UAE and Saudi. Saudi is mostly sovereign, and the UAE, the GRE is also more active than the sovereign issuances for the hard currency debt market. So coming to the Sukuk market. So overall, globally, Sukuk market corresponds to around 1/5 of total Islamic assets, and ranks second after the banks. And looking at the global issuances, not the GCC wide type, Sukuks are mostly sovereign and quasi-sovereign, but the corporates are relatively small portion. And in the year 2021, there was around 3.4% increase in the global sukuk issuances, which the increase was driven mainly by the sustainability and the green sukuk issuances. And here, overall, the sukuk market, Malaysia, Kingdom of Saudi Arabia, Indonesia, leads the market with Kuwait and Turkey coming later on. But in the year 2021, as a sovereign issuer, Saudi outpaced Malaysia with the 31 billion total of issuance during the year. Okay. So the next we will maybe discuss about ESG sukuk issuances. So ESG sukuk issuances reached 5.3 billion in the year, and 29% of it was the green sukuk. And again, here also, most of the ESG sukuk was driven by the Saudi Arabia, Indonesia, and Malaysia. Going forward in April next month, Saudi's local currency sovereign sukuk is to be planned to include it in the FTSE EM bond index. And this will help provide a benchmark to allow performance comparison across the debt markets. Egypt, countries like Egypt, Tunisia, Algeria, there are always plans to issue sovereign sukuk. But one way or another, it didn't happen actually. Every year it is on the plan. This year also it was planned. I mean, there are concrete plans, and to make it in the first half of 2022. But as I said, I don't know if it goes on or not, given the current macroeconomic risks, let's say, and the increase in the CDS and the yields, because Egypt yields have been elevated recently after the Russian crisis, on the fears of the repercussions on the tourism and the actually economy. Okay, so okay. And here is like a performance comparison similar to the equity markets. And with increasing bond issuance, of course, as we explained in the previous slides, the GCC's weight in the emerging market bond index has been surging recently, gradually, to 22% from as low as 2% 3 years ago. And in 2021, as well as outperforming the global markets in terms of the equities, the GCC and MENA outperformed in terms of the debt markets as well, with small positive returns. Small positive returns, and which of course driven by the fundamental credit positives like the oil prices, benign outlook, and contained inflation thanks to the peg to the dollar, and the fact that the governments in like UAE and Saudi Arabia are subsidizing energy prices and not reflecting to the end user, thanks to the strong balance sheet. If we look at the credit quality of the debt instruments in GCC, it is quite positive, with over 75% is at or above A- category. And the next slides. Okay, here again, as I said, the GCC, debt markets yielded small positive 0.1 for the full year, given that their yields seemed attractive given the risk-reward basis for the investments. So as we discussed the outlook in terms of equities, we could go briefly on the credit markets as well. The primary implication of what we have discussed so far would be that the overall bond issuance could decrease during the year, given very strong balance sheets, given that oil prices, hover around 105 as projected by the EIA of the US, or even 90, etc. It would be very fine for their already strong balance sheet. One other thing is could support is the relatively positive credit ratings of these countries and the positive outlooks of these countries. I mean, sovereign issuances could decrease, as I said, but what we could see is, as these countries have a heavy focus on the sustainability on the ESG front, given their hydrocarbon focused energies, they should go more towards renewables, given their carbon zero promises for 2050 or 2060. These will definitely feed into more demand for the debt issuances in the renewable energy targets and energy issuances we could see. And we could see maybe government-related entities could issue more debt than the sovereigns. And of course, the high yield sovereigns like Oman and Bahrain will have to continue to borrow. And what would be the risks? Of course, the high overall global interest rate environment and the repercussions of this Russia-Ukraine conflict would be negatives. But the GCC seem relatively isolated from these inflationary risks there, given their high quality rated bonds and the outlook of inflation being much more contained versus peers. For Egypt, around 26 billion of Egypt's debt will be included in the JP Morgan index in this year. So this could help attract some cash inflows from passive fund managers for Egypt during the year. And of course, the other driver for the 2022 issuance would be ESG, as I touched upon before, as UAE and Saudi announcing their net zero mandates, and many regulatory authorities and the corporates establishing sustainability frameworks. On the sustainability front, some of the steps or the actions taken by the regulators include, for example, in UAE, the stock market authority made it mandatory to issue annual sustainability reports by the companies. And as the fourth quarter of 2021 financials are out, we have all the sustainability reports in all details from the UAE listed companies. And Kuwaiti Stock Exchange also launched its new ESG guide, as well as the most recent announcement came from the Saudi, which also announced its disclosure guidelines for the ESG. Okay. And the last thing to briefly discuss would be the fintech capital markets. And in the year 2021, around $4.7 billion was deployed in the Middle Eastern companies across 251 deals, and 30% of this capital raised by fintech companies in the region was deployed in the early stage companies, as seen in this lower figure. So these are the rating actions for your reference, and that's it. I can take any questions you might have. Thank you.
Thank you very much, Nazan, for a very comprehensive, remarkably comprehensive presentation. And honestly, I'm overwhelmed. But may I ask the first question? I just want to try to have a consolidated takeaway from all these discussions. And I address these questions as well to Mr. Engine. In all these economies in Middle East and North Africa, what are the major similarities and the major dissimilarities in their capital markets? And if you may, could you distinguish between the equities and the debt market? So what are these similarities and dissimilarities? I'm trying to compare it also with the other Asian countries, because the answer to this will give us an idea of what do you call this? What kind of policy reforms we might want to push for, and what kind of reform contributions or reform ideas ACRAA could also contribute. So what are the major, in your mind, major similarities and dissimilarities in the capital markets, perhaps in their, not just in their status, but in their process of development? So that's my question.
Okay. So I think in terms of both equity and debt, and particularly I have given the GCCs, over the years perspective from 2010 to 15 and 2021. In the last 10 years, there was a huge growth in the debt markets, which is the one thing. And similarly for the equities also, the major listings like Aramco came in 2019. So if I separate the MENA as to GCC and the others, right? So GCC,
Okay.
so GCC, what is their long-term goal? Let's say the world is going away from hydrocarbons to renewables and etc. Net zero, ESG taking center stage. So what GCC wants to do is do as fast as possible and as much as possible to do this transformation and to diversify their economies, right? So
Okay.
diversify their economies, they have the strong balance sheets in the wealth fund and the government, they have a huge fiscal receipts. And we see Saudi and UAE particularly because they are the bulk of GCC, right? Then Qatar comes the third, and Oman, Bahrain is smaller countries. So they are trying everything to diversify economy away from oil to non-oil sectors like retail, tourism. Saudi is building a new city, their big city plan, and tourism. So like the services sectors will take the stage, hopefully, let's say, in the long run. And their financial market steps are, I think, going in line with these goals, let's say. But if, as you see from here in this table, aside from these, GCC countries, the market cap of Jordan is very small. Tunisia is only 8 billion, and Damascus is negligible, and Beirut is very small, and even Egypt Stock Exchange is very small. So these are, so I will separate MENA into two regions like GCC, and particularly Saudi and UAE, which are in the middle phase of their development, let's say. They are growing very rapidly in the capital markets, but they're in the middle phase. But the others, rest of them, mostly are the infant phase in terms of equities. And in terms of debt, also aside from the Egypt, I think GCC and Egypt, aside from them, again, the MENA region is at the infant stage, let's say. Okay, this is the main thing that I think I would say. And if you look at the steps taken by the leaders like UAE and Saudi, they are I think, following the global best practices, IMF guidelines, World Bank advices, and etc., etc. In the corporate governance, in every aspect of the capital markets, they are following the footsteps of the best practices in the world, in the sustainability as well, in the ESG. That's the thing I would say, I think.
Thank you. Mr. Engine, would you have your answer to the same question?
Yes, of course. Just to add a little bit color after Mr. Hassan, and his presentation was quite comprehensive, obviously. So just to touch upon a few points about how Turkey differs from perhaps other emerging economies. I think we can I think I can make like these points. First, from a macroeconomic perspective, from a cultural perspective, and from the current, let's say, technology dynamics. So for the macroeconomic perspective, I think one of the main issues is this inflation, as I have outlined in my presentation. So currently we are going through a phase of very high inflation. So during that period, developing the capital markets is quite difficult actually, because when you have like 50%, 40% annual inflation, then the investors will be looking for like meaningful returns. But currently, most of the real returns in capital markets in FX are negative actually. So to convince people like to invest in the long term in the capital markets, I think limiting inflation, like maintaining it in a very low level is paramount. So I think this is one of the macro dynamics. And the second macro dynamic is, I think, the persisting current account deficit problem. So from the balance of payments perspective, current account deficits automatically means a finance account surplus. So you have to roll it with current account matches with foreign inflows. So for people, and this automatically means a savings deficit. So we have a savings deficit, which actually means we are importing foreign investors' savings. And this is what the current account deficit means. So to reverse it, to develop the market here, we actually need to transition into a model of more current account surplus or a less of a deficit, so that people would start investing here, I think. But I think these are the macro points. From a cultural perspective, I mentioned the dollarization issue. It has increased almost up to 65% of total deposits, and some of it is held in gold. And people not in the banking system, but hold physical gold actually in Turkey as an inflation hedge, as a crisis hedge, as a backup fund, like emergency saving funds, let's say. This is a cultural issue and it's quite notable. So we need ways to convince these people to participate in the capital markets and show them it is good for everyone involved. So this is a cultural perspective. And one of the more positive lights, actually, from a technology perspective, I did not dive into it in detail, but actually in capital markets in Turkey, one of the major developments is in the private equity scene concerning the technology startups. So just to give two examples, one of them is Trendyol, which is an e-commerce company, and it had been acquired by Alibaba, the e-commerce giant of China, as you all know, and the current valuation runs around like $15 billion. So this is quite big, and there have been many other startups operating in e-commerce. And another startup, and it's not a startup anymore, is a delivery company called Getir, which is kind of like Global and Deliveroo and Uber Eats. So it's essentially like delivers food and whatnot into your home. It has been growing quite a bit in Turkey, and it has grown in Europe, and it's expanding its presence. And it is also raising a lot of funding, and its current valuation is, if I'm not mistaken, around $12 billion. And I am tying this to the broader capital markets now. We now have a mechanism, like legal mechanism, to crowdfund these investments. So people, even retail investors, can now, at least there are ways to participate in this funding rounds from a retail investor perspective. So now they can also jump in to this private equity scene. I think this is one of the major distinctions in Turkey now, because we have this ecosystem of fintechs and other technology startups. We have human resources dedicated to this, and it is actually a growing scene. I think we will have more of these companies. And another example is the mobile games. Several Turkey-based companies have been acquired by foreign US-based or EU-based companies for like billions of dollars, and they are also like boosting the capital markets here because that funds are used to fund other startups. So I think that pool is growing.
Okay, thank you. Hassan, would you like to have any follow-through comment after Mr. Engine?
Actually, maybe one thing in common I could say, when the brother Özgür was talking about the culture, it reminded me something about, this. In my tables, I also had a, figure, I think. I think this region, we see one of the common thing is the very low foreign participation in the equity markets. It's something, for example, in the MENA region, historically, for example, if you look at Turkey, the foreign participation was much higher. 72% at its best days. I think now it is much, much lower, but it was much, much, higher than the MENA at all. And it is because of course, these, political things in Saudi and UAE, of course, their, way of government is different than Turkey. Of course, it's a thing, but there are foreign ownership limits in the main regions in the GCC. I think this is something to maybe mention.
Okay. Sabine, did you want to say something?
Yes, I just wanted to add regarding your question previously to Hassan regarding MENA. I think it's just important to remember that because the currency in the entire GCC, and actually even outside the GCC, a number of countries have these pegged currency regimes, which I think the rest of the world is perhaps not as familiar with. And the biggest implication of that is that the monetary policy is not independent. When the monetary policy is not independent, it means that it's difficult for the central bank to control, to take actions. And the pricing pressures in these markets are very indigenous. They're very, home to this region. They're very unique to this region. So what happens as a result of not being able to control the monetary policy is that you cannot control supply of liquidity in the markets. You cannot manage growth in the market, and that perhaps is one of the reasons that we have seen some very lackluster movement in financial and capital markets. So I just thought that this was one point that needed to be kept in mind, that although Hassan mentioned that currency is pegged, another offshoot of this is that the monetary policy is not in control of the central banks in this region.
What do you say, Mr. Engine, about what Sabine has just said, especially with respect to Turkey?
Yeah, I think yes. Since Turkey has this float currency and GCC has its pegs, and we don't think about it too much, but yes, I think its nature is quite important in that regard as well. But from the monetary policy perspective, like currently, like I mentioned, we have like negative yields in most of the instruments. So people are trying to find alternative ways to invest their money to maintain their purchasing power and preserve their wealth. So I think this one. And speaking of monetary policy, there was another point actually. I think it's quite important as well. In Turkey, Turkey has a disproportionate interest in crypto markets. So we do not talk much about crypto. In fact, there was a paper recently published by Bank of International Settlements, and it shows that Turkish investment, like in Turkey-based investors, account for almost 20% of USD-backed stable coins. And according,
Is that right?
yeah, this is almost insane. Like there's this bar chart. I will try to find it in the meantime. I don't want to take your time. So maybe as we skip to other questions, I can locate that chart. This is quite incredible. So there is this also big crypto exchange called Binance. Perhaps you're familiar with it. So Turkish investors constitute a very large portion of this Binance sphere. So the crypto market is very big and very notably growing. In fact, there is a survey. I've just located that survey. Let me share my screen very quickly to give you a flavor.
Okay, let's.
So, can you see this? Let me.
Yes.
Okay. So let me just quickly remove the grid line so you can have a better look. Okay. So this is historic, right? These are quarters from 2017. So this is the most recent. So this purple bar, you do not see it before. This purple is actually crypto. So this is based on a survey on households, and it says 10% of people's total savings were invested in cryptocurrencies. And this compares with, let's say, so this bar is, we mentioned gold. This is gold in the banking system. So gold index deposits, we might say. So this is gold and this is crypto. So I think this is quite striking. And because this blue bar is, let's say them the out of system savings. So these are either like currency, like physical cash or physical gold people keep in their homes in, I don't know, vaults and whatnot. So when you combine them, like a lot of the savings, like perhaps maybe half of them are actually not in the system. So I think we need to push for ways to like divert these funds into the banking system, into the capital markets, so that, you know, we might see some growth on that side.
Okay, Hassan, what do you make out of this?
Comment here before. I'm sorry. I just want.
Go ahead. So that you're there.
Yeah.
Go ahead, Fahim.
I'm feeling very well now. Thank you very much, Sandy. A last comment here. You know, the cryptocurrency, people thought that it is invisible. You remain invisible. You cannot be tracked. Day before yesterday, USA said that any Russians who have invested in cryptocurrency could be tracked, and they will try to block the cryptocurrency investments. They will track them. So it means the cryptocurrency has to be now thought where it can be tracked now, so it is not very invisible. So I think that it is a game changer now between Russia and Ukraine, and what now the policies and what the technology can do now, which was not thought before, and the people, investors thought they cannot be tracked. So I just wanted to make a point here that cryptocurrency is also can come under investigation.
By whom, Fahim?
By the USA can track them. Who, I don't know really, but that was a very big point which was debated continuously on the TV channels on tracking the cryptocurrency because they wanted to track the oligarchs in Russia, and they know who they are and how much money they have been transacting into cryptocurrency. So that's a very big issue now that it is not invisible.
There is, of course, a very big move to both track and regulate the entire segment. As we heard in this live hearing that we where the Fed chair was speaking, and you know, there was a lot of discussion on regulating this. So I think we are going to see something shortly.
Okay.
Yeah,
what's your take, Hassan?
Okay.
I'm sorry?
No, I was addressing Hassan. I thought he wanted to say something.
Okay. Actually, as the brother Özgür mentioned, you know, I also live in Turkey. You know, I am connected from Turkey, and I mean, our dynamics is extremely different and diverging from what we see from the GCC. You know, GCC, as we showed, they have 2% inflation, and they could easily, I mean, retail investors could easily outperform this. And we see, you know, in the Saudi and UAE, there is a huge retail participation in the, I mean, stock exchanges, etc. But in Turkey, inflation is over 50%. I mean, to be honest, I don't remember exactly. I mean, Brother Özgür mentioned maybe 53, 54. I mean, we live in very different world and little bit diverging from the realities of the conventional macroeconomics. So we want to offer maybe 15, 17% deposit yields, while the inflation is 55%. So it is, I mean, people are really crazy if you come to Istanbul, take the subway, the bus, old ladies, young kids, everyone talks about crypto. I mean, it's like crazy, you know, from babies to very old, because people, I mean, these anti-orthodox policies, I think, let's say, and unfortunately pushed our people into sort of this kind of stuff, you know. But GCC, it is very easy. You can beat 2% inflation with anything, you know. You can conserve your purchasing power, and etc. But in Turkey, there is no way to defend your, you know, savings, let's say, aside from, I mean, if you stay in the gold or, you know, USD, it's a different story. But I completely agree with Brother Özgür, unfortunately.
Just one point that I would want Brother Engin to elaborate on is that when inflation is 50%, when yields are as negative as they are, so they are roughly 37% negative, and with the lira being where it is, with continuing downward pressure despite the state guarantee, and now it's, I believe, 14.4, which means that it's breached the state level indication of when it's going to start putting you know, compensatory payments in people's accounts. My question is, first, on the local currency debt viability front, with this inflation and this much negative yield, which means that refinancing is a problem for companies, potentially, don't you see a very high risk of bankruptcy?
Yeah,
Brother
for the
Engin
corporate-
first, and Brother Hassan later, because Brother Hassan I can ask perhaps later also, but your views on it, Brother Engin.
Yeah, sure. So yeah, you're correct to point out that inflation is affecting a lot of things. So from the bank's perspective, what they're trying to do from their asset and liability management, let's address the government's debt aspect. So local government is actually issuing a lot of CPI-linked bonds. So they are quite popular with the banks. So this is helping banks quite a bit. And they're trying to replicate the same thing with the companies as well. So in Turkey, typically all of the commercial lending we see are actually fixed lending rates. And when we talk about like 3 or 4 year tenor lira rates locked in, so this is quite problematic for the banks. So what they're trying to do is to promote this variable rate lending facilities. So now the banks are trying to at least not deal with the interest rate risk themselves. But then, of course, this leaves the non-financial companies with the interest rate risk itself. But currently, the commercial lending rates are around like 22-23%. I might be mistaken. So they are still actually have access to funds at negative rates. So the trick, I think, is to balance it, right? Now they have access to this, let's say, low cost, I mean, 23%, but faced with 50%, it is a low cost financing option. Let's say they have access to this low cost funding. What they do with this funding is very important, right? If they use it for FX heavy investments, then of course, inflation could go into a spiral. But I think what the administration is trying to do is to have some selective credit policies and like focusing on less FX demand and more FX inflow. So if they can manage it they can manage the FX rates at these levels, then I think that's the game plan. But of course, Russia and the energy crisis have been unexpected headwinds. They have been altering this game plan. So I don't know how this will go. But from the bankruptcy perspective, I think private banks have good capitalization, so they are restructuring if necessary to maintain the, let's say, liquidity flowing in the system. State banks had relatively lower capital adequacy ratios in Turkey, and now they are being recapitalized by the sovereign wealth fund. So probably this will help, let's say, their balance sheet. But I agree. I mean, this is a major issue, and I think FX rates is the most important in our history as it has ever been these days. It is affecting everything. In fact, inflation, public finance, non-financial corporations, bank balance sheets, it's affecting everything. I think it's the main thing to watch.
Farial, will you please take over for a while? I'll just excuse myself for 2 minutes. Farial, we have a question from the chat box.
Yes, Mr. Santi, I'm here. I'll do it.
By the way, if I may, I have located the BIS paper where I mentioned Turkey's disproportionate share. So if that's okay, I would like to share the screen to point out this graph, because it's quite striking. Okay. So, like I mentioned, this is the stable, so-called stable coins. You know, they are somehow backed by a fiat currency. So this is Turkey. I mean, no one is even close. Like, and I've checked actually the data. The BIS also shares data and Excel format. So I said 20. This is 17.5% total share. Turkey alone. And this is quite unusual, actually. So this probably ties in with the inflation and negative real yields. So I think this is something to watch as well. And I am also referencing this paper in the chats for everyone to check for themselves.
Thank you very much. So there's a question that you would want that's been addressed to you, Mr. Engin. Based on your capital market data, 99% of the investors are individuals. As per Al Jazeera, 11 million people in Turkey are crypto holders. So in the condition of continuous depreciation of the lira, how do you think capital markets will behave when crypto is getting popular day by day?
Yeah, well, I mean, for crypto, I think like Mr. Fahim made a great point saying that crypto is probably not the safe haven like people think it is, because it can be managed. Like a lot of wallets could be shut down. I mean, we have even observed this in Canada, right? I mean, Canada, like a Western country, all about free markets and liberal ideas and whatnot. But we have seen the protests, especially by the truck drivers, and there have been attempts by the government to freeze their crypto assets, and in fact their bank accounts as well. So these things are risks, and I think people would probably be like waking up to this fact, and hopefully sooner than later. And I think, in fact, a more important risk than the capital markets itself is to the investors, crypto investors. In my view, what the typical crypto investor in Turkey views the crypto exchanges, and they think they are the same as the banks. So Mr. Hassan made a great point. Like, crypto is so popular, even your typical old lady is investing in crypto. Even the teenager with a Starbucks cup in his hand, like 15-year-old teenager, is investing in crypto. And for them, any crypto exchange where they see on billboards, on buses and whatnot, they think investing in this crypto is same as putting your money in the bank. And what I mean is, they do not think about the counterparty risk and the credit risk. So we have bank deposit ratings in the rating environment, right? We try to assess the viability of the bank's position. What about those crypto exchanges? They are not very well regulated, and not in Turkey, but also globally as well. There have been many issues of frauds, of bankruptcies of the exchanges and all sorts of problems where the investors could not get their money from the system. So I think this is a very big risk currently, and probably this will take some regulatory push, like much stricter capital, let's say, thresholds, like only exchanges exceeding a certain capital threshold should be able to collect these funds and whatnot. So I think this is the main risk, actually. And as for the depreciation aspects, this might actually be fueling it, because all of the investments in these cryptos, if they are placed in exchanges overseas, then they result in an FX outflow, right, from a capital accounts perspective. So this might actually be adding fuel to the fire in case of volatility. So I think they should be regulated quite closely. This is what I think.
Okay, we have one more question there. I know we're doing overtime, but perhaps we can entertain this last question. Let me
Yes,
see.
it is from Mr.
Ariel,
Masuda San. Yes,
could
it's
you
from
read it
Mr.
first?
Masood. Right. The question is from Mr. Masuda San to ACRAA participants. What impact will higher oil prices bring to capital markets in the GCC? Will higher oil prices reduce the market size of the debt markets in the region, or will higher prices lead to further expansion of capital markets due to augmented fund volumes?
Sure. I will address Sister Faryal. But before,
Thank
I will
you.
just add one sentence to Brother Engin's answer to the Mr. Zain Ayaz. Also, aside from crypto, I mean, personally, what I observe is that in IPO market in Turkey is very lively these days. There are many IPOs. I mean, I want to pick my words carefully, but these IPOs, as far as I see, I read the reports, they are very low quality companies mostly. And I mean, and they attract the investors, but investors are entering, these IPOs just to earn like 20% in a given day. They are, I don't want to say this, but they are sort of speculative, things are also going on. Of course, they are under the realm of our capital market authority. But these, inflation and everything had yielded influx of IPOs with relatively low quality, let's say, in Turkey. I mean, it's my observation. And for the GCC and GCC oil market, I was in the outlook. Of course, with this huge spike in the oil prices, the sovereign issuances will be lower. And sovereign issuances will be lower, particularly for Saudi, which is trying to hit some certain debt thresholds internally set. But there would be, as I also mentioned, there would be some issuances on the renewable energy front and some issuances on the GREs and the corporates. I think it will balance out because they have to do huge investments in the renewable energy, and they have some infrastructure investments, also huge, very huge energies. I mean, projects to diversify away from the energy. So I don't think that there will be, shrinkage in the oil overall debt markets, Mr. Asushi. Thank you.
With the exception of, obviously, GCC is the area which is very much reliant on hydrocarbon. But apart from Oman and Bahrain, two very small economies and very small participants in the GCC market, two very small participants are the only ones which need about $80–85 per barrel to be sustainable. Everybody else is actually sustainable around $65 to $70 a barrel, which means that the current prices are very large. And while they're unsustainable, we still feel that the big issuers will actually have surplus liquidity. So a counter argument to what Brother Hassan is saying is that, and because GCC government debt is the leader, 80% of total debt issuances is government. And because the governments are likely to be flush with money right now at this point, it is possible that the government segment will shrink, and because that is overwhelmingly the largest segment, that could point to a significant decrease in new issuances.
Fine. It has been a very, very interesting morning, afternoon, everybody. Thank you very much to our speakers, Mr. Hassan, Mr. Engin, and to all the discussion, including Sabine, all those who raised questions. We should have more of this actually, but this is really a very nice starter and eye-opener for a lot of people, particularly for myself. So again, on behalf of ACRAA, thank you very much, everybody, for your attendance. Thank you, our speakers, and thank you for all your interest. So we will now say, for now, until we meet again, somewhere in the Middle East or North Africa, or perhaps Istanbul. Again, thank you very much, everybody. We shall adjourn this wonderful, interesting webinar right now. And keep safe, everybody. Thank you, thank you, thank you. That ends our session.